What's up, guys? Happy Sunday. I'm sure you guys understand that there are literally an endless possibility of strategies you can use to trade options in stocks. For example, you can buy vertical spreads, you can buy put spreads, bear spreads, you could buy butterflies, iron condors, you could buy, naked puts, you could buy naked calls. The possibilities are endless, right? You could also do something like this. You could just 1 second, you could do this. Here. All right. So for example, if you have like computerized and everything working for you, you can say, for example, you think the market is going to fall intraday, but then it's also going to ultimately bounce afterward, right? To make things a bit more complicated, you could buy puts over here, and here. And then basically you've bought 4 different positions of puts. Potentially, this is obviously not, like a perfect trade, but you buy puts at 4 different situations. You think the market is going to end up falling lower, but then it's going to bounce. So what you do is you can buy calls here, and here. And as the market is falling lower, you buy the calls here, but you also sell out of the first put position that you bought. As it falls even lower, you sell out of this put position, you buy even more calls. Same concept. So as you've fallen lower intraday, you've taken positions of puts, you've taken profits on those puts as we fell lower, and then at each level, you've also entered into calls. So now what you've done is you've maximized your put profitability on the downside, but at the same time, you've been scaling into calls. For example, 360 could have been like the lowest level, right? What could have ended up happening is if this didn't work out, hypothetically, right? The put positions that you had up here, you would just stop out of them if the market ended up bouncing. And we can go into depth of so many different types of trades, essentially, that you can end up making. But specifically on Friday, what I was saying was very, very simply a one-directional trade. I wasn't really worried about anything else. All I was saying was I wanted to scale into calls as we continued falling lower. So here's essentially what a lot of people ended up doing. Here's essentially what you should have ended up doing. So at the first candle, at the first minute, you automatically, what I said was I'm buying into calls. What people ended up doing is a lot of people ended up buying very, very heavily. I specifically said that on Friday that I wasn't going to be playing disciplined. I wasn't going to have any stop losses, and I was going to continue scaling in as we made newer lows. So obviously I want the market to continue falling lower because I knew that there was going to be a bounce, right? So the first mistake is people over leverage themselves during the first minute of the trading day, which is obviously not good. What I wanted to end up doing was continue scaling in as we only made new lows. I was not buying into anything into strength. I was waiting for newer lows, right? And what this ends up doing is the more times you scale in at the bottoms, your average ends up being green. And as it ripped to the upside, obviously if you've positioned yourself properly, these gains, for example, on Friday, I got into, just for example, the 365 calls. If you had even bought the 365 calls, by the end of the day, those contracts were up almost 300%. So the initial positions that you bought over here, a 300%, 365 calls, when you should have bought 3 more times. As we continued falling lower, you should have averaged in more because we continued falling lower. The 365 calls were up 300%, made up for the losses of the first initial few buys. So if you continued buying in as it fell lower, that was the ideal trade to make here today, on Friday. But what people ended up doing was they did not continue scaling in as we fell lower. They over leveraged themselves at the higher portions of the day, and then basically once we fell lower, they saw the contracts down like 90%, which is obvious, right? Especially with zero DTEs, those are obviously going to be eaten by theta. But if you continued scaling into zero DTEs as we continue falling lower, the 365s were up 300%. 364s and the 363s, I don't like the 364s. I don't even want to mention it because it's like you should have been scaling in as we fell lower. But essentially, people don't, I mean, like it takes a lot of time to understand these different nuances in the market and understand position sizes and everything like that as well. So I'm going to try to do a much better job at making people understand the nuances in terms of position sizes and when they should be positioning themselves and how heavily they should be positioning themselves. So that's something I'm going to go in depth on the course that I'm essentially going to make as well. Obviously, I'm not going to charge for it, but there's so much to this. So for example, I mean, we could just say, for example, you had $10,000 account, right? Obviously, you should. What ended up happening is right at the beginning, people threw $2,000 into this trade, which is you're not supposed to do. So ideally, what you should have been doing is you should have, since this is the first buy, very, very risky. I wanted it to fall lower so we could get a higher average. You should have only put maybe $200 or $300 into this initial buy, right? You buy again as we made this new low and created this bottom here. You could have put another $300, right? If the market never fell again, this would have ended up being a profitable trade, and you would have only risked about $600 out of your $10,000, right? As we continued falling lower, the more extreme we ended up falling lower, you could have put more money. You could have put more money, more money, more money, more money as we fell lower. And by this point, at most, you would have only risked, obviously, with a $10,000 account, you have to be way less, you have to play much more, you have to be more disciplined with a smaller account, essentially, right? Because you have less bullets in the chamber. And if you average down too heavily, you're going to be left with like 20 to 30% of your position into a trade. And that's not very safe, because if this trade didn't end up popping, then you would have ended up losing a big portion of your portfolio. But ideally, what you want to do is you want to scale in very, very light in the initial points that you're buying, right? Very, very light. As we continue falling lower and lower and lower, that's when you start averaging in. At that point, say for example, even if you put 2, 2, 2, 2, and then you start putting in 5, 5, 5 as we fell lower, these contracts were up 250, 300, 350% at least as we made this bounce. So the initial $200-$300 losses that were down 90%, that we got, the 370 calls, the 369, 368 calls, etc., those were all eliminated as you averaged down heavier. And you didn't even need to average down heavier. Even if you just did it with the same exact position sizes. Obviously, it's not ideal to buy in with the same position sizes as you fall lower. Even if you bought in with the same position sizes as we continued falling lower, it would have nullified all of this. And yeah, essentially, that's how I usually trade all of these days. So now, next time this happens, you guys could look back at this video and just understand that I like the weakness, because the more weakness we have, the higher likelihood we would have an aggressive bounce. And that's exactly what happened basically as soon as 3 o'clock started. We bounced very, very heavily, and you know, we had ample amount of time to average in and everything. But unfortunately, it's not really unfortunate, because this is something that people have to actually learn, and not many people are even talking about things like this: position sizes as you fall lower, scaling in. These concepts aren't things that are really even taught in courses, or people like that charge and everything like that. They don't really teach these different nuanced details. So this is all a learning experience. You can't beat yourself up about this. I should have done a better job at explaining. First and foremost, I should have done a much better job at explaining people the risks associated with everything, and position sizes, etc., etc. But I just got very excited, so I I lost sight of that. So it is what it is. I'm going to do better moving forward. But in general, you guys now understand a much better thing here. I was just aggressively bullish the entire day. There was nothing else to really think about. All I was doing, literally, I was just scaling in as we fell lower. And yeah, I think I did a good job at explaining my thought process. But yeah, that's the video for now. Let's start with going over the stock market and what the next steps are for the SPY, the NASDAQ, the IWM, and maybe even the crypto market. All right, so let's get started. All right, so this is the SP 500 on a daily chart. You can see that we're opened and closed outside of the lower level of the Bollinger Band, which is algorithmically very overextended. You guys know how much I love this trade. You could also see that the RSI is oversold on the daily chart. We're at 29 essentially on the RSI, and the MACD is also very oversold. We are currently oversold on and closed and opened outside of the SPY, the IWM, and the NASDAQ, and it's beautiful, right? So I like this. One thing to take into consideration is that a few weeks ago, we were monitoring the history of opening and closing outside the Bollinger Bands and what that meant for the price of the stock moving forward. Generally, it only took about 2 or 3 days for us once. So for example, on August 29th, when we made this open and close outside of the lower Bollinger Band, right? Generally, it only takes about 2 or 3 days for us to break above this candle's high. What ended up happening was it took over a week. We continued falling lower. It was unprecedented weakness, and then we didn't end up breaking back above until September 9th and 10th. So this obviously was extreme weakness that we saw out of the NASDAQ less than a month ago. All right. So yes, obviously when this happens, you're supposed to be bullish. But what we just saw a month ago was that this same setup was not aggressively bullish. Currently, we're still I'm still holding on to Monday calls, next Friday calls, and I scaled into a lot more calls for a few weeks out. I'm expecting a bounce. We're still closed and opened outside of the SPY, the lower level of the Bollinger Band. But of course, we can continue falling lower. But at the end of the day, this is a high quality trade setup. We have to take it to the upside. And that's essentially what I was doing. I was scaling in as we continued making newer lows. And yeah, I'm expecting us to get some sort of a bounce, maybe even potentially back up to 373.50, which is basically a gap fill of here. So basically we made a gap, and I feel like the upside target can easily still be 373.50. Even 370, 372, essentially, even if we get above, that would still be very, very profitable for all of the calls that we have. But moving forward, once again, what we need to see, right? Regardless, like this is a complete like crapshoot, regardless of what happens, right? The levels that we need to see closes above and that we need to see it maintain above are 2 main levels. Essentially, we need to see the SPY hold above 371. And we need to, in my opinion, we need to see 2 closes above this falling trend line here. So for tomorrow, that level is going to be perfectly coinciding with this 371 level. So we need to get a break above this level, a hold, and say, for example, we make a candle here, right? What's going to end up maybe happening the day afterward is we might get a retest of this candle and then a break upwards. So that's sort of what I'm expecting here. I don't think this move to the upside is going to be that perfect, but regardless, right? That could be the case. And then the main level that we want to see it break above is going to be this trend line here. The initial lower level of this falling wedge pattern that we were monitoring. And because we broke below the falling wedge pattern, I said that there would be cascading weakness. And that's the cascading weakness that we saw into the end of last week. So now that lower level is going to act clearly as resistance. All right. So those are the 3 main levels moving forward. And really, that's what we're going to have to look. So we can see the dollar is very overextended to the upside, showing a clear strength, but it's very, very overextended now. We might have a day where we can get a period of consolidation. If we get a period of consolidation for the dollar, it could be bullish for the stock market. Similarly to the 30-year bond, we continued to make newer lows. But what would be nice is if we could see these lows hold. Ideally, what we want to see on the bonds is we want to see a break back above 130.22, and that strength in the bonds can easily translate into the stock market if we break back above these levels of resistance, in my opinion. The VIX obviously also skyrocketed, so a lot of these indicators need some time to simmer down for another potential leg down. So the only times that we want to be bullish during bear markets is during extreme periods of weakness. So that is currently what we're seeing right now. In the short term, we can continue vomiting, right? But we are clearly in a very, very extreme period of weakness. The RSI is oversold. The Bollinger Bands are oversold to the downside. So it makes sense to continue buying puts with momentum as we continue breaking below support. Buying puts at resistance. Those are basically the safest trades to make in a bear market. But you can also scale into calls at support, especially during weakness, and that's what we're doing basically, right? So we have a lot to look forward to in a few hours once futures open. So it's going to be very, very exciting this next week. I'm also going to be trading very, 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 very disciplined. Strict stop losses, and everything. So we're going to have stop losses for all the trades. I'm going to give certain levels, like, okay, I'm buying SPY calls right now. I have a stop loss below 365.50. If we break below 365.50, I'm not selling. If we get a 1 minute close below 365.50, that's when I would sell. So yeah, man, next week is going to be very, very exciting. Moving forward, it's going to be very, very exciting. There's clearly like a lot. So one of the things is that I have to also do a much better job explaining certain things and certain concepts. So I'm going to be doing a lot of that as well. So it's pretty exciting stuff that we're going to be seeing in the next few weeks. But yeah, I hope you guys enjoyed today's video. Happy Sunday. I'll see you guys tomorrow. If there's anything else that I could help with, please drop them in the comments. I'll do the best that I can to explain certain concepts and do everything. But yeah, make sure to like the video, comment, subscribe, do all that good stuff. And I will see you guys bright and early tomorrow morning. Thank you.